Hello and welcome to Rajya Sabha Television. You're watching The Big Picture with me, Frank Rausam Pereira. India's economy grew at 8.2% in the April-June quarter of 2018-19 on strong performance of manufacturing and agriculture sectors, increasing its lead over China to remain the world's fastest growing major economy. The gross domestic product at constant prices had grown at 5.6% in the April-June quarter of last fiscal, according to government data released on Friday. The previous high quarterly GDP growth was recorded in January-March of 2015-16 at 9.3%. The Chinese economy had expanded at the rate of 6.7% in the April-June period this year. India's GVA for the quarter under consideration has been estimated at 8%, up from 5.6% in the year-ago period. The CSO said that manufacturing activities expanded at the rate of 13.5% in the quarter under review. The sector had witnessed a decline of 1.8% in a similar period last year. On this edition of The Big Picture, we will analyze the growth drivers of the Indian economy. Joining me on the program today are Nitin Desai, former Chief Economic Advisor to the Government of India; Ashok Kumar Jha, former Finance Secretary, Government of India as well; SP Sharma, Chief Economist, PhD, Chamber of Commerce and Industry; and Abhinav Prakash, Assistant Professor, University of Delhi. Thank you to all my guests for joining me on this edition of The Big Picture. Mr. Desai, I'd like to begin with you first. On Thursday, we had a discussion. We spoke about India's growth outlook as far as the RBI is concerned, and you said we have to wait for Friday to see how the Q1 figures are. Today, they are in front of us. What do you think?
Well, I'd say that basically, as I said that day, that if it goes beyond 8% or so, it means that we are more or less on track for what RBI and IMF are projecting. Only thing I would say is be careful. What we tend to do when we look at these quarterly numbers, we are comparing them with a year before. Now, it so happens that the first quarter of last year was actually the lowest point of GDP growth. So there's a bit of a base effect. So if I were the government, I would not tom-tom this too much, because it is very likely that possibly in the third quarter, second and third quarter, because again of the base effect, the growth rate will dip. And it's largely what I have started doing is to look not at the annual thing, but how does the quarterly growth rate compared to the previous quarter do? Because that gives you a better sense of what's happening now, what the pressures are now. And it's very clear that the biggest single driver of growth has been government spending. Heavy government spending, which is not bad at all, because a significant amount of it was on infrastructure. Incidentally, much of it in the state sector, not in the center. The center is not that big a spend on the capital side, but the states are, particularly on roads and things like that. The areas of worry was not very different from what we said 2 days ago, and that is that basically the investment, one thing which disappointed me slightly in the numbers from Friday was that the uptick in investment that we had seen in the third and fourth quarter of last year does not seem to have been maintained in the first quarter of this year. If I look at the growth compared to the previous quarter, because that tells you a sense of what the speed of movement is at the moment. Exports actually this quarter seem to have done a little better than expected, but I continue to believe that our greatest threat is the widening current account deficit because of oil prices, because of what may happen to world trade, because of all these trade wars that are going on. And if, as I said, that we are likely to have a deficit of around 75 billion, and that's a difficult deficit to finance.
Right.
50-55 is fine. Not fine, but we can finance it. But 75 is a tough call. So you will face pressures on that front, on the exchange rate front, on the foreign exchange reserves front, and with the oil prices going up, they'll also face this problem. Do I allow prices to go up, or do I reduce excise duties in order to keep prices stable, but then I'll have a deficit problem? So in that sense, there are still some very serious issues of management on the fiscal side and the balance of payment side.
Right. So there has to be a good balance going forward is what you're suggesting. SP Sharma, India Inc. of course cheered, as the economy grew at a 2-year high. And what do you believe has contributed to this growth?
Majorly, the broad-based recovery is there in the GDP numbers, starting from the agriculture sector. Agriculture sector is growing more than 5% in the first quarter. So that is a good thing that will boost up the manufacturing growth in the coming quarters also. And the manufacturing too itself grew at the rate of 13.5%. That is the result of the end of teething problems of the GST. I believe these two major revolutionary reforms like demonetization and GST impacted and undermined the growth rate of FY18. Now the growth is again on the track, and there is a broad-based recovery starting from the agriculture, construction, manufacturing, and these all sectors are the employment-creating sector. That is the good thing, that construction sector, which grew at the rate of 8.6, 8.7%, is a major sector which can create a lot of employment opportunities, and the manufacturing sector at the 13.5%, and the major contribution in the manufacturing sector is from the MSME sector. So going forward, we have to boost up the export scenario, as mentioned by Mr. Desai, that is a worrying factor, that our external economy is not that much in the lucrative trajectory as compared with our GDP numbers. So we have to increase our exports to reduce the trade deficit, because the trade deficit is widening very rapidly. The trade deficit during the last year, during the last 4 months, like April to July in the FY18, was at around, I believe, $52 billion. But now the trade deficit in the last 4 months is $62 billion. So trade deficit is widening. So we have to reduce the trade deficit with the increase in exports. We cannot stop the imports at this juncture because the rupee is depreciating. So the value of imports will increase. But we have to reduce this trade deficit by increasing the export segment, and particularly the exports in the labor-intensive products, because majorly the large three sectors like the petrochemicals, gems and jewelry, these are the import-intensive raw material products, because we import a lot of products, raw material from the foreign markets, which are also becoming dearer because of the depreciating rupee. But if the labor-intensive exports are boosted, then we have a good room to reduce the trade deficit in the shorter period also. But that should not be a major worry, because we have enough forex reserves also, and the FDIs are growing, and CAD, current account deficit, can be addressed by the increase in the capital account, because overall balance of payments, I believe, can be addressed, because FDI inflows are good and grew by, I believe, more than 20% in the first quarter. And last year FDI inflows were also very good, $62 billion. So if the FDI is growing at the rate of 20-30%, or somewhere between 20 to 30%, that is a good thing for the Indian economy, that we have a good room to address the balance of payments. But we have, in the longer run, we have to address our trade deficit scenario with the increase in our exports, which are at this juncture very, very challenging, because the global growth is growing at the rate of, I believe, at around 4%, 3.9% is projected for the current year. But we have to capture this global demand, which we are not able to capture because of the domestic vulnerabilities, because of the some problems of the refunds of the exporters, and some infrastructural problems, logistics problems. So if all these problems related to the export logistics are addressed, and the refunds are majorly eased out, then there is a good room to increase our export trajectory. Exports should have a growth of at around 20-25% at this juncture, with the global growth growing at the rate of 4%. So the major challenge is from the external side, as mentioned by Mr. Desai. But at the domestic level, all the, I think, business is as usual now.
Okay, business is as usual as far as the domestic front is concerned. We need to concentrate on the external economy, and we need to export more, is what SP Sharma is suggesting. Let me go across now to Abhinav Prakash. From a recent low of 5.6% to 8.2% now in Q1, what steps taken by the authorities really have contributed to this, do you think?
First of all, we have to look this growth pattern in a bit of a long term. The government inherited a growth rate which was around 5%, right? That shot up to 7% in the initial years of the government, but there were lots of fluctuations in those growth rate. And then you have the shock of the demonetization and the GST being implemented. But since the last year, you are seeing a consistent upswing in the economy. The growth rates are going up. Now, I kind of disagree here when Mr. Desai that we have to look quarter to quarter growth rate, because quarter to quarter growth rate are always fluctuating. So our analysis will also be fluctuating if you're focusing only on that. So we have to look a bit of a longer term picture. What is happening is a couple of things. First is the massive spending on the infrastructure by the government. Second, obviously, is the GST, which is now started paying off, because once you are creating a unified market, you are removing the logistic barriers, the movement of the trucks in the country, that it itself creates a positive upspin to the growth. Third point, which is often overlooked, which is not being talked about, is the massive spending on the utility sector by the government, like electrification, toilet construction, house construction, and so many other things. All those things come together like Digital India, and they create a positive externalities for the rest of the economy. That is very difficult to capture in number directly on a one-to-one basis, but that is actually pushing up. I think that is started showing up its impact on the wider economic growth rate. Like there was a report saying that all the sectors linked with the toilet construction are showing an upswing. Right? So the demand have increased across the country because of that. The third point is the agricultural sector, what we see today. The agriculture after a very long time is showing some positive sign of revival. It's difficult because of our agriculture is still dependent more on the monsoon and the rains, but we are seeing an upswing which is also boosting the growth rate. Fourth point is the consumer expenditure. So what is happening is that the growth is not as much driven by the private investment, but more by the private consumption. So government investment, as the sir was saying, and the private consumption, which is a bit of a problematic era, because unless and until you have the private investment reviving in the country, you cannot have a sustainable growth rate in the long run.
How long is the government going to continue to keep pushing this growth, isn't it? Because private consumption too has to pick up at some point in time. Let's talk about some risks now, Dr. Desai. You know, it's an election year, let's not forget. So do we need to be wary of policy paralysis at some point in time?
I'll leave the worrying about that to others, but let me say this, that yes, this is always a problem. Like one problem that they will face is that in an election year, they'll have this dilemma with oil prices. That if I allow prices to rise with international oil prices, I may have a backlash. But then if I reduce it by cutting excise, then I may have a fiscal deficit problem. So yes, there will be that type of dilemma which will arise. I'm also a little more concerned perhaps about the international side than maybe some of the others are, because I think the international environment has become very unfavorable. You know, there is a lot of uncertainty. You look what you see, for instance, at the catastrophic decline in exchange rates in places like Turkey and Argentina, very suddenly, very sharply, without real warning. You are also the possibility of a continuing Israeli trade war. What Urjit Patel, the Governor RBI, has talked about, possible currency wars. So I'd say that at this stage, I hope that the government has some sense of contingency planning on what to do if there are sudden disruptions. What will you do if the Iran sanctions really start biting and start hurting the oil industry? What will you do if the US-China trade war leads to serious disruption of global trade patterns? So I'd say that my main risk concern is this. I'm also not as confident on the fiscal side as maybe some other people are. There's some fear that we may be a little under pressure in maintaining the, because you know, one key area, as we said the other day, of the divestment is not moving. We have nowhere near get the targets of divestment which are included in the budget. So there are issues on both fronts, on the CAD front and on the deficit front. I still think there is a problem of reviving investment, and we tend to focus on corporate investment. But if you look at the numbers, the big drop from 34% to 29-30% in investment is because of the fall in household investment, which includes MSMEs and small sector, non-corporate. The proportion of corporate investment to GDP, even of government investment to GDP, has not fallen that much. In fact, it hasn't fallen. It's largely that. So why? Why is that not, when will that pick up? And that I think is very, very crucial. And I hope that this is also being addressed in some form.
Right.
Mudra and all that is fine, but I think there are deeper problems in addressing the slowdown.
All right. Let me bring in Ashok Kumar Jha, former Finance Secretary, Government of India, into the picture now. Mr. Jha, we were initially, of course, talking about what are the factors that have enabled India to grow at 8.2% in Q1. And now we have obviously moved on to the risks, really, as far as the Indian economy is concerned. You can probably start off by talking about the growth drivers, really.
Well, I think before I get into that, I would like to say a few words about the GDP numbers, because there's been a lot of debate about the GDP numbers and as to whether this is something to be cheering about or something to be cautious about. I think, just comparing it with the previous year's 5.6% quarterly rate of growth, and saying that because the last year's growth rate was very low and therefore there's a base effect, I think does not do full justice to the fact that the economy is turning around slowly. Because if one looks at quarterly rates of growth right from 5.6% in the first quarter of last year, every quarter the GDP growth numbers have been improving. From 5.6% it went to 6.3%, from 6.3% it went to 7%, from 7.7% it went to 7.7% in the last quarter of last fiscal. So therefore, this 8.2 shows that the trend of growth is very positive, and I for one am pretty happy, and I would think that it's a very optimistic picture that is being laid before us. Now the growth drivers, of course, have already been mentioned. They are in the GDP numbers, and you also mentioned in your opening remarks that is basically manufacturing, it's construction, it's maybe government expenditure and so on. But I think for somebody who has to look at the economy, the future in the next few quarters, I think the dangers, some of them Dr. Desai has enumerated, and I would like to emphasize particularly two of them. One is the protectionism that seems to be gaining ground internationally. As it is, our exports have not been doing too well, and with the increased protectionism that is now seems to be on the anvil, we may have further problems on that. And the second issue, of course, is the oil prices, which is anybody's guess as to where they will settle at. If they continue to remain at the present levels, then I think we have a pretty good fiscal year coming up during 18-19. But if the sanctions against Iran continue to bite and it has a cascading effect on the oil prices, then we may be in for some problems, both in terms of fiscal deficit as well as in terms of current account deficits.
Right.
So these are the two external issues. Internally, I think what one needs to worry about is the fact that investment has not really improved in terms of I'm talking of the private sector investment. Government investment has of course gone up, but the private sector investment is still not picked up adequately. So this is a cause for worry. And the other would be the inflation. I think if the currency continues to depreciate as it has been depreciating, and of course which is a normal phenomena, then it would have an impact on the rates of inflation. And that is another worry, because if the inflation rises, the RBI would obviously step in to correct it, and that could further put in jeopardy the efforts at increasing private investment.
Right, all right. So the bottom line is external economy is something that we need to worry about, and we also need to worry about investment or private investments picking up. Talking about the external economy, SP Sharma, what measures, what steps do we need to take so as to ensure that we get a boost on that front?
As I mentioned in my previous discussion, that there is a need to focus on the exports. We have to increase our exports, and exports, there is a good potential to increase the exports also, because the global demand is reviving. But we have few domestic challenges, because one was the export refunds that is now slowly becoming usual, and now that is eased out. So in the coming quarters, we can expect some revival in the export growth trajectory. Now the exports are somewhere between 10 to 15%, and we have potential to grow in the level of 15 to 20%. That will be a big respite to the rising current account deficit and the trade deficit. That is the one thing that we have to increase our exports. And second thing is that we should reduce the unwanted imports. That there are a lot of products which we can produce in our territory. So we should reduce the content of unwanted imports also to address the current account deficit and the trade deficit. And the third one is to facilitate the businesses and to create the domestic demand. If the domestic demand is there, that can be a good respite to the overall growth momentum, and we can grow in the a positive trajectory in the momentum that we are growing at the rate of now 8.2%, and the next quarter, if the growth number is also good, that can address the challenges of investments also. That will boost up the private investments also. Now as mentioned by Mr. Jha, that the growth quarter after quarter is becoming intact. So the growth is intact, and there is no challenge to the growth rate. Then the private investments will also become visible, and there will be a good rebound in the private investment. That will be a good strength for the economy, overall economy, for the external sector also, and for the domestic level also. Why for the external sector? Because we will be able to grow faster at the domestic front and to produce more and to procure less from the foreign markets.
Right.
Because what is happening, that we are importing more and producing less. That's why the current account deficit is widening.
Sure.
If the investments are happening from the government side and from the private sector side, then the consumption can be met by the domestic sources of production.
Okay.
So that will be a good respite to the economy, and we can address lot of problems if the private investments revives, and there is a good room to revive the private investment as the growth is becoming intact quarter after quarter.
Right. Abhinav Prakash, as easy money draws to a close, as the trade wars intensify, do we need to be concerned about emerging market stress?
Yeah, definitely. What is happening today is that you can no longer rely on the America, which so far has acted as the engine of the world's economic growth rate. The Trump's America is simply unreliable. You don't know what it's going to do. Second is the China, which is also not willing to play that role of the engine of the world's growth, despite benefiting from it for a long time. So as the easy money regime is coming to a close, it is going to be a problematic thing for countries like India, right? So we no longer have this boom in the credit market, the easy availability of the credit, which is going to have the impact both on the private consumption and also on the investment. However, when talking, just to talk about exports, when we're talking about the international market, see, there are two things. I mean, you can no longer rely on the America and China to be a market for your exports, neither Europe because of the trade war, but also there's a domestic problem that you need to do labor reforms. And this is an election year. I don't think that is going to happen. We opened a factory at Noida, the world's largest mobile factory of Samsung, and there were protests by the labor unions over some issues. So how do you tackle this issue? To increase your exports is also a big thing, because in the long run, you cannot solve the problem of a falling rupee without adjusting the current account deficit.
Since you mentioned a plant, we had the Tuticorin incident as well, and because of which we are suffering majorly as far on the copper front is concerned.
Exactly. So some protests were basically done on the basis of unreliable facts, and the plant was shut down, and we are beginning to face the problem because the prices of the copper is shooting up now. So we have to tackle lots of things, not just the international market, but the domestic front is also shaky as far as the labor reforms are concerned. I think being an election year, we cannot expect some big bang reforms, but I'm pretty sure that something will be done at the incremental level.
Closing comments now from all my guests. Dr. Desai, rising local interest rates as well. Is that going to be a factor as far as limiting the growth is concerned?
Well, right now, the Monetary Policy Committee has taken a neutral stance. And so you don't have to assume that they raise the rate, but it's possible if there is a pressure on prices. But I don't think there'll be pressure on food prices. If the deficit is controlled, I don't expect inflationary pressures, demand-led inflationary pressures on the non-food, the non-energy side. The pressure will be mainly on energy side because of crude prices. So I'm hoping that the inflation thing can be kept under control. We do not have interest rates. What you may face is that because of the narrowing gap between our rates and, say, rates in the United States, the flow of there's a lot of investment coming into our debt market. And remember this, a falling rupee affects that. You'd consider a person who's invested in India in January and has to mark his investments to market. He has to mark it down by 10% just because of the rupee change. Yes, the value may have gone up, but the fact is that it doesn't look very good to him, right, because he has to mark it down in his books by 10%. So right. I would say that there may be some pressures on the Reserve Bank to start escalate if international interest rates also start moving up.
Right. Mr. Jha, you did mention in your opening remarks that the economy has constantly grown since 5 quarters ago at 5.6 to 8.2 in Q1 of this fiscal. What can we expect in the quarters to come?
Well, I think in the quarters to come, if everything remains the same, then we should get overall growth rate for this current financial year at about 7.5%. Basically because from quarters 3 and 4, the favorable base effect will obviously peter out. It will not be as strong as it is going to be in the first quarter and the second quarter. But if we have a situation where the external factors are not favorable, and even the internal factors, because of various reasons, hike in interest rates and so on, the internal factors are also not favorable, then we could have a problem in the sense that we may then struggle just to get even to 7%.
Okay, all right. Closing comments from my other two panelists in the studio as well. SP Sharma, first from you. What else needs to be done as far as the industry is concerned, do you believe?
My suggestion is that we have to focus on the agriculture sector, because agriculture sector is a good strength for the economy, and agriculture sector grew at the rate of 5.6% for the last quarter. And if the agriculture sector is strengthened more by the domestic level reforms and particularly the agri infrastructure, then there is a good room to increase the agriculture exports, because there is a market of $1,300 billion globally in the agriculture and food imports, and we have the presence of only $30 billion despite the agrarian economy. So we have to increase our agriculture exports to the foreign markets, and there is a room to increase with the facilitation from the reform side, from the government side, with the increase in the rural infrastructure and rural roads and the agriculture infrastructure. So if the food processing sector is focused more, then we can address a lot of problems. Firstly, by that will be a boost to the manufacturing sector also, because of the increased income level of the rural people, and second, that will address the trade deficit also with the increased exports to the foreign markets.
Right. Abhinav Prakash, close the show for us with your closing comments on the way forward for the Indian economy.
Well, I think we have to focus two things immediately. One is the NPA problem. That remains to be tackled despite the IBC code and the efforts. We still have to cover a lot of ground before we clean up the corporate balance sheet and the company's balance sheet and the bank's balance sheet. Without that, the private investment is not going to revive in the long run. Second is that we have to focus on the fiscal deficit. The extra budgetary resources, that borrowing is going to breach the highest level this year, and that is going to have an impact on the inflation rate and lots of other things as well. So I think we have to walk a very tightrope of balancing the fiscal deficit, boosting the economy by the investment. I think the government should focus now, mainly in the coming months, resolving these NPA problems in the power sector and the other industries.
All right. Q1 results of this fiscal, of course, are excellent, and it seems like we are on the right track. The future looks optimistic is what the guest panelists are suggesting, but also a lot more needs to be done in the near future, even presently, and also in the long term as well, so as to ensure that the growth continues. With that, it's a wrap on this edition of The Big Picture. Thank you to all my guests for joining me on the program and putting things into perspective for us. That's it from me. See you again next time.